Hey everyone, welcome in. I'm so glad you could join us today
Yeah.
because we are diving deep into a topic I know a lot of you are really interested in and struggling with. And that's this crazy stock market we're in right now. I mean, figuring out if you should be a buyer or a seller or just hold on for dear life. It's it's tough right now.
Yeah, it really is.
Kind of feels like, trying to predict the weather in a hurricane right now. Right.
Yeah, exactly.
But the good news is you've sent us some really interesting stuff that we're going to dive into today. We've got insights from Michael Pinto and Felix, and we've got, some good market data and analysis. And our mission today is to really just cut through the noise and help you make sense of what's happening. Understand the forces that are at play, and then give you guys some strategies for how to potentially, build some wealth in this market, whether it goes up or down.
Oh,
So let's just jump right into it. One thing that really stood out to me was this contrast between Michael Pinto and Felix.
mm-hmm.
Pinto is painting a pretty sobering picture. He says the market is priced for absolute perfection, which, I mean, I guess that implies that any little surprise, any little hiccup could send things tumbling down.
Yeah, and he really dives into the reasons why he thinks that way. And one of the things he points to is the shrinking Federal Reserve balance sheet. And historically, when that's happened, it has not been good for stocks.
Really?
Yeah, it's often been a sign of trouble.
So it's like the Fed is taking its foot off the gas or maybe even hitting the brakes a little bit.
Yeah, that's a good way to put it. And he also talks about liquidity, the amount of cash that's sloshing around in the market. And he's showing in these charts that, this high-powered money, as he calls it, is being drained from the system. So it's like the fuel that's been propelling these stock prices higher is starting to dry up.
Wow. And he even points to record low treasury high yield spreads as another potential warning signal. So he's basically saying that the easy money that's been pushing the market up is going away.
Exactly. And because of all that, he's actually predicting a pretty significant correction. He's talking like a 50% drop in stocks and even like a 40% decline in housing.
Whoa.
And he attributes that to this concept of reversion to the mean.
So basically what goes up must come down.
Yeah, it's the idea that, asset prices, after they've been inflated for a while, tend to eventually go back to their historical averages.
That's a pretty scary thought.
Yeah.
But then you've got Felix, who's way more bullish. He thinks we could be in for a big rebound.
Yeah, he's looking at the historical data and he's saying that years following a 10% market decline like we just had often see some pretty impressive gains.
So like a rubber band snapping back after being stretched.
Kind of like that. And he also makes a really interesting point about the role of algo funds in the recent sell-off.
Algo funds.
Yeah, you know those computer-driven trading programs.
Oh, right, right.
Says they've been dumping huge amounts of S&P 500 shares, which is, adding to that liquidity crunch that Pinto's worried about.
Oh, so it's like Pinto's fears about liquidity are actually playing out in real time through these algorithms.
Yeah, it's a really interesting connection.
It really shows how complex this all is. So on one hand, we've got Pinto's warnings about a correction, and then on the other hand, we've got Felix's optimism based on these historical trends. And then on top of all that, we have all this political uncertainty, like the trade war with China and all the back and forth with those tariffs. It's enough to make your head spin.
Yeah, definitely.
But before we get too overwhelmed, I think we need to take a step back and figure out what this all means for the average investor.
Absolutely.
Someone who's trying to make smart decisions with their money. So where do we even begin with all this?
Well, I think a good place to start is to break down these different factors, liquidity, historical trends, and political uncertainty. And then we can look at how they might impact the market in the short term, the midterm, and the long term.
Okay, that sounds like a plan. Let's do it.
So let's start with that short-term outlook. We're talking like the next 6 to 12 months. And I think Pinto's concerns about liquidity are really important here. If that easy money keeps drying up, like his charts are suggesting, it could definitely put some downward pressure on stock prices.
So in the short term, should people be thinking about selling their stocks or maybe moving some of their investments into cash?
Well, that's a tough question, and it really depends on your own personal risk tolerance and your investment goals. If you're someone who really freaks out when the market gets volatile, having some cash on hand can definitely give you some peace of mind. And it also gives you what they call dry powder. You've got some money ready to buy stocks if the market does dip.
That makes sense. So it's not necessarily about selling everything, but more about having a plan for how you're going to react if things start to go south.
Exactly. And that's where Pinto's idea of actively managing your portfolio comes in. He suggests that you should be adjusting your mix of stocks and bonds based on things like inflation and economic growth. So it's a little more hands-on than that buy and hold strategy that a lot of people use with index funds.
Okay, but isn't that really hard to do? I mean, trying to time the market perfectly seems almost impossible even for the experts.
Yeah, it definitely has its challenges. Even the pros get it wrong sometimes. But that's where understanding things like dollar cost averaging can be helpful.
Oh yeah, dollar cost averaging. Can you remind me what that is again?
Sure, it's basically investing a fixed amount of money at regular intervals, like say every month or every paycheck. And you do this regardless of what the market's doing. So when prices are low, you're buying more shares, and when prices are high, you're buying fewer shares. It's a way to kind of smooth out those market fluctuations over time and hopefully reduce your risk.
Gotcha. So even if you're worried about a correction in the short term, dollar cost averaging could be a way to kind of protect yourself a bit.
Exactly. It takes some of the emotion out of it and helps you stay disciplined even when things get crazy.
Okay, that makes sense for the short term, but what about the midterm, looking at a year or two?
Well, in the midterm, I think we need to consider both sides of the coin. You know, Pento's worries about a correction and Felix's argument that history is on our side and we're due for a rebound. This is where things get really uncertain because we've got these two opposing forces and it's hard to say which one is going to win out.
So in the midterm, it sounds like having a diversified portfolio is more important than ever.
Absolutely. You don't want to have all your eggs in one basket. Spread your investments across different asset classes, different industries, even different countries. That way, if one area takes a hit, your whole portfolio isn't wiped out.
And how do those tariffs play into the midterm picture?
Well, clear value tax makes an interesting point. They say those tariffs are mostly just a negotiating tactic. So if they're right and those tariffs don't turn into a full-blown trade war, then the market might eventually calm down and start going up again.
So there's a chance that all this tariff drama could actually create a buying opportunity if stocks get too cheap.
It's definitely possible. Value investors love to find those moments when everyone else is panicking and stocks are on sale. But of course, there's always risk, and there's no guarantee that any particular investment will go up.
Right, of course. Okay, so we talked about the short term and the midterm, but I know a lot of people are wondering about the long term,
Hmm.
5, 10, even 20 years out.
Yeah.
What should they be thinking about?
The long term is where Felix's argument about historical trends gets really interesting. Because if you look at the stock market over really long periods, it's always trended upwards, even with all the corrections and recessions along the way. And that's where the power of compounding really comes in.
Compounded, that's where your gains make more gains, right?
Exactly. It's like a snowball rolling down a hill. It gets bigger and bigger over time.
So even if we do have a correction in the short term or even the midterm, history suggests that the market will eventually recover and keep growing.
Yeah, that's been the pattern, of course. Past performance doesn't guarantee future results, but it does give us some context. The key is to have a long enough time horizon so that you can ride out those inevitable bumps along the way.
That makes sense. Now, I know a lot of our listeners are wondering about whether they should be investing in individual stocks or if index funds are a better way to go.
Yeah, that's a big question, and there's no easy answer. It really depends on your risk tolerance, your investment goals, and how much time and energy you want to put into managing your investments.
Pinto seems to be a big fan of actively managing your portfolio, picking individual stocks based on his economic analysis.
He is, but you have to be realistic about how hard that is. Even professional fund managers have a tough time beating the market consistently.
So for someone who's not a financial expert, are index funds a safer bet?
Index funds are great because they give you instant diversification and they usually have really low fees. And historically, they've done really well. So if you're okay with a more passive approach and you believe in the long-term growth of the market, index funds can be a great choice.
But what about people who want to be more involved in their investments?
Yeah.
Who enjoy researching companies and trying to find those hidden gems?
There's definitely still a place for that.
Yeah.
There's a certain thrill that comes with finding a company you believe in and watching it grow. And there are definitely some skilled investors out there who are able to beat the market by picking the right stocks. But it takes a lot of research and a lot of time, and you have to be comfortable with the risk.
Okay, so we've talked about the short-term, mid-term, and long-term outlook for the market. We've talked about diversification and different approaches to investing. But I'm curious, what are your personal thoughts on the current market environment? Do you think we're headed for a recession, or is this a buying opportunity?
Oh man, if I had a crystal ball, I'd be a rich man. But I think it's important to remember that fear and uncertainty are what really drive market volatility. And right now, there's a lot of fear out there.
Yeah, I mean, you've got Pinto talking about a potential crash, and we've got these trade wars looming, and just a general feeling of unease about the economy.
Exactly. It's easy to get caught up in all that negativity. But I think it's important to step back and look at the bigger picture. The economy is still growing, unemployment is still low, and corporate earnings are still strong. Those are all good signs.
So maybe instead of panicking, we should be looking for opportunities.
I think that's a valid perspective. Market downturns often create some of the best buying opportunities for those who are brave enough to stay invested.
So it's not about timing the market perfectly, it's about time in the market.
That's a great way to put it. Yeah, and that brings us back to one of our main points. You know, knowledge is power. The more you understand about how the market works, the better decisions you're going to make.
So true. So true. Well, I think this has been a great deep dive. We've explored a lot of complex stuff today,
Yeah.
liquidity, historical trends, those tariffs. And it could definitely feel overwhelming, especially when you're trying to figure out how to invest your own money.
Yeah, it is a lot to take in, but I think the biggest takeaway is that there's no magic formula for predicting the market.
Yeah, we've heard from Pinto, who's, ringing the alarm bells. And then we've got Felix, who's more optimistic. And then Clear Value Tax is in there talking about those tariff negotiations. I mean, if the experts can't agree on what's going to happen, it just shows how uncertain everything really is.
And that's okay. Embracing that uncertainty can actually be a powerful approach to investing.
What do you mean by that?
Well, instead of trying to predict what's going to happen, which is impossible, focus on what you can control. You can control your emotions, your reactions to the market, and most importantly, your long-term strategy.
So it's all about having a plan, diversifying your portfolio, and not letting those short-term market swings throw you off track from your long-term goals.
Exactly. And remember, market downturns, as scary as they can be, they often create some of the best opportunities for people who are able to stay invested.
It's like that old saying, right? Be fearful when others are greedy, and greedy when others are fearful.
That's the one when everyone else is panicking and selling their stocks. That's often the best time to be buying.
But that takes a lot of courage, to go against the crowd and stick to your plan when everyone else is losing their minds.
It does, but that's where knowledge and a solid strategy really come in. If you understand how the market has behaved historically, if you've done your research and you believe in the companies you're investing in, you're less likely to get swept up in all the emotion.
So it's about being an informed investor, not just reacting to whatever the market is doing at any given moment.
Exactly. It's about understanding the bigger picture and making decisions that are right for you.
And remember, there are resources out there to help you guys with this. There's Pinto's portfolio strategies and the Felix and Friends Masterclass, and of course, tons of information online. And you can always talk to a financial advisor.
The key is to stay curious, keep learning, and never stop asking questions.
Couldn't have said it better myself. Well, that's all the time we have for today. Thanks for joining us on this deep dive into the stock market. And remember, folks, knowledge is power, especially in a world as crazy and unpredictable as this one. We'll catch you next time for another deep dive into something interesting and hopefully helpful. Until then, take care and happy investing.